Good morning, students. Welcome back. So today we plan to start with a new chapter. Okay, so that is chapter 7. So we are going to now continue on the accounting standards only, but it's about those standards which are going to impact the items of the financial statements. Okay, not specific to the liabilities, the one that we were discussing in the previous session. Okay, so I'll just share this presentation, just a minute. All right, so AS4. So we plan to start with this AS4. Yeah. So AS4, this largely talks about certain events, certain conditions which are required to be looked at, which are or which will take place after the balance sheet date. A very important topic in relation to the preparation and the presentation of the financial statements. Important in the sense that this is something which is required to be looked at always, and which will flow down to almost every entity. Yeah, so we'll just try to understand the perspective around it as to how this is really relevant. Okay, this also touches upon one aspect about the contingencies. Okay, which is briefly touched upon in this standard, but it's more about the events which will be occurring after the balance sheet date. Okay, so what is a contingency? You can say it's a condition or a situation, ultimate outcome of which, whether it's a gain or loss, will be known or determined only on the occurrence or non occurrence of one or more uncertain future event. Yeah, so this is something which is dependent on something to be happening in future. Yeah, so that's how you will be looking at it. Yeah, so now if you have to understand about the contingency and as to what sort of loss is possible in respect of this, so what I'll do is I'll just share one small example through which we'll just try to get some clarity around this. Okay, so now if you look at this example, ABC has filed a case against a debtor for a recovery of 25 lakhs. Now, in this case, if you talk to the legal team, the chances of recovery is nil. Therefore, what should you do? As an entity, create a provision. Yes or no? Yeah. So create a provision for the same. Okay. So now this is when you create this provision. So this outcome as to whether this money will be recovered or not. Now this has become contingent. And as regards this recovery, we can't really say whether this money will be recovered or not. And if at all this money will be recovered, whether the entity will be able to recover this entire amount or maybe only a part amount. Correct? Yeah. So that is completely dependent on the discussions which are going to take place. Yeah. So that's how entity will be dealing with this data on the basis of various discussions, on the basis of maybe the litigation, if they really get into a litigation. Yeah, so the outcome of that will decide as to whether this money will be recovered or not, and whether this money will be fully recovered or only the partly recovered, right? So in this case, what do you do? Estimation in the sense that this money is not known as to what is going to be recovered. So other than that, everything you will provide. Yeah, so that's how we'll be going about it. So the estimation of the amount of contingent loss to be provided for in the financial statements may be based on judgment, okay, which has to be made by the management. Okay, and of course around this, management will be giving a disclosure in the financial statements. Correct? Yeah. So these are some of the situations one can really look at. Now moving on to the next area and that is about events occurring after the balance sheet date. So now this part is important because this entire standard is all about the events which is occurring after the balance sheet date. Okay, so let's try to understand this as to what is this event which is occurring after the balance sheet date. Okay, so now if you look at this chart, let's try to understand as to what is the balance sheet date. So balance sheet date is this 31st December. Okay, so we have this calendar year as the reporting year. So that's why balance sheet date is what? 31st December, right? Now, during the year, that is 1st January to 31st December, any transaction that we take, that will take place, any sort of event, any transaction, all of these will be required to be recorded by the entity. Yes or no? So in the normal course, that is what you will do. That will be recorded by the entity, correct? So now, as far as this part is concerned, this is our reporting period. You can say this is the year in which the accounting will have to be done. Okay, now, now, after this reporting period, means after this balance sheet date. So what is the balance sheet date in our example? 31st December. So any date which comes after the balance sheet date, what do you call it as? What do you call it as? Period after the balance sheet date? Yes or no? That is what you call as the period after the balance sheet date. Correct. Now after the balance sheet date, entity will be working on the financial statements. Okay. Closure of books of accounts. Yeah. So some sort of accounting entries will have to be passed. Yeah. So all of these things, all of these activities will be going on after the balance sheet date. And generally, there's a time frame. Generally, the management will keep a time frame. What is the time frame? The time frame within which the accounting has to be completed, financial statements will be drawn, then the audit will have to be completed, and once those are audited, they will be presented to the appropriate level of management, or you can say the authorized personnel who will be authorizing the financial statement. So for a company, it has to be the board of directors, right? So let's suppose in our example, this date is 17th of March. Okay, so this is the date when the financial statements will be signed off. Okay, now any date which comes after the financial statements are signed off. So you can say that will become our second cutoff. So our first cutoff is this balance sheet date. Our second cutoff is financial statements have been signed, or you can say they have been authorized. Correct? Now, you may be thinking that after the financial statements are signed, what are going to be the activities? So what all things will be looked at? So there are a lot of activities, more of administrative in nature. For example, they will have to be published. Okay, they will have to be printed, because this will also go for the AGM, wherein the shareholders will be looking at it. So one sort of approval of shareholders will be required. Correct? That will also have to be filed with various regulators. So there are a lot of activities which take place after the financial statements are signed off, or you can say after the financial statements are authorized. Okay. So all of these activities we are saying are the one which is coming after the financial statements are signed off. Okay. So that's the period. Okay. Now, There are two periods we are going to look at. First, which is between this 31st December and 17th March. So what is this period? This period is the period between the balance sheet date up to the period financial statements are authorized. Okay, so that's first period. The other period is the period after the financial statements are authorized. Correct? Yeah, everyone clear? Yeah, so these two periods are clear. Quickly, these two periods are clear. Yeah, simple. Okay, great. Now as regards these two periods, some accounting adjustment may have to be required. Okay, so that is now important for us to look at. Now, what is this accounting adjustment? Why are we looking at any accounting adjustment during this period or during these periods? And how is that relevant at all for our reporting year? So in this case, what is the reporting year for the company? Can you tell me what is the reporting year? Over to you quickly. In this case, what is our reporting year? Tell me quickly. Yeah, so Prem says that is 2014. So can you tell me the complete period? What is our complete period for the reporting? Anil says 2014-15. No, that's not a financial year in the given case. Jendra says 1st January 14 to 31st December 14. Very good. Yeah. Now this part is very, very important because till the time you don't understand our reporting year, you will not be able to understand the remaining accounting requirement. Okay, so everyone clear? Okay, so I can see similar response coming from Soumya, Mohammed, Prem. Very good. Okay, yeah. Now what is our objective? So let's try to understand. Our objective is to finalize the financial statements for our reporting year. Okay, so that's the objective. Means currently we are preparing the financial statements for the reporting year. 1st January 2014 to 31st December 2014. Clear? That's the reporting year we are looking at. Okay. Now, in relation to this reporting year, we are now looking at any event, okay, which will take place after 31st December 14. But up to 17th March 15. Any event, okay. But if let's suppose there is any event which takes place after 17th March 15, that is not going to be relevant for us as far as our reporting year is concerned. Okay, so to begin with, that is not going to be relevant to us. So Priyanshi is asking, sir, is this similar to the subsequent year from auditing? Yes, similar in the sense that for the auditing, the accounting requirement which the auditor will check will be similar. Okay, but otherwise, now the perspective is that of the management. Perspective is not that of the auditor. So that's the only difference. Okay, now if you look at this period from 17th March 15 onwards, will this have any impact on the reporting year, which is from 1st January 14 to 31st December 14? Answer is no. Answer is no. Okay. Yeah. So that means this period can be completely ignored by us. Why? Because this standard AS4 doesn't talk about this period. It says it's outside the scope of accounting standard. So if there is any event, any transaction, any sort of thing, whether that is favorable, unfavorable to the company, you will ignore that. Fine. Yeah. Okay. Now this is very, very important. Why? Because that's how you will be deciding as to what is going to impact the reporting year. Okay. So first line we have looked at, that we need to draw this first line on 17th of March. Now let's talk about this period from reporting date to the date when the financial statements are authorized for issue. Means from 31st December to 17th of March. Now, this is the period which is relevant for us. So let's understand as to what is the requirement of the standard. Standard says any event that occurs after the balance sheet date, means that occurs after 31st December 2014, but before the financial statements are authorized for issue. Okay, which takes place before the financial statements are authorized for issue. That means up to 17th March 2015. So those events are required to be evaluated. Why? Because there are two ways you can record those events. This is not an option. We'll talk about that accounting requirement also. What are the two ways? See, some of those events, you'll record that when they occur. Okay, on which date you record? When they occur. Means you will occur, or you will record them during this period only. Some of those events. So no. In fact, any event, when do you record? When they occur. Yeah. But some of the events which occur during this period may have to be recorded or disclosed during the reporting year itself. So you may be thinking that, sir, how can we prepone the accounting of those events? That is what this accounting standard guides you. Yeah. So that is what we need to understand, that what are those events which occur after the balance sheet date, but which will have to be recognized in the financial statements for the reporting year. Reporting year means this year ended 31st December 2014. Okay, so this was all about the context that we are discussing. So we have not discussed the accounting requirement as such. We are just discussing the context as to what is required to be done. Clear? Yeah. So there are two periods we have talked about. One, which comes after the financial statements are authorized for issue. So we are saying we don't need to look at that period. Any event which will take place during that period, we need to ignore that. Second, which takes place after the balance sheet date, but up to the date financial statements are authorized for issue. So that is going to be the period which is relevant to us as far as this accounting standard is concerned. Okay. Yeah. Clear on the periods. Any questions, any doubts so far? Any doubts so far? No. So Deepika is clear. Okay, so Priyanshi is asking, sir, the event happened after 31st December 2014 have to be recorded in financial statements for the year ended 31st December 2014. So this will have to be estimated. I'll talk about it. Okay, so we'll discuss as to whether you will estimate that, what will become the basis of that recording. We'll talk about it. Yeah. All right. Any more questions? Anyone else? Quickly. Any questions? Any doubts over here? No? Clear on this? Okay, great. Now let's understand as to what is the accounting requirement and what are these two types of events. Now there are two types of events. One is called as adjusting event. Second is called as non-adjusting events. So let's understand both these events. Now please remember that while we'll be discussing all of these events, these are the events which have to occur after the balance sheet date. Okay? Yeah. So let me just write this also. Balance sheet date to the date of approval of financial statements. Okay. So this part you need to remember. Now, during this period, the events that will occur need to be divided into two categories. Or you can say those could be of two types. One that you call as adjusting event. Second is non-adjusting event. Now, what is the meaning of adjusting events? Adjusting event means that for such events, you will do the adjustment in the reporting year. So we are talking about this situation. Means those events which even though occur after the balance sheet date will have to be recorded in the reporting year itself. Clear? Those will have to be recorded in the reporting year itself. Okay. And what are non-adjusting events? Those are the events which occur after the balance sheet date, but you will not have to record them. Means you will not be required to recognize them. Recording means recognize them in the reporting year. In the reporting year, in respect of non-adjusting events, only a disclosure will be good enough. Yeah, so a disclosure in the financial statements will be required. That will be good enough. Okay, so that's how you need to look into it. Now, let's try to understand both of those events one by one. Now, how do you decide whether the event is adjusting or non-adjusting? Yeah, so that's a question now. Yeah. Now, when do you call the event is adjusting? When do you call the event is non-adjusting? Standard says events that provide further evidence of conditions that existed at the reporting date. So any event which takes place after the balance sheet date, but for which some conditions existed as on the balance sheet date or during the reporting year. Okay. That is what you call as adjusting event. For example, say there was a court case going on. Okay. So there was a court case going on. Say this is 31st December. So company was into a litigation. Okay. Now during this year, litigation was going on, or you can say at any point of time, the litigation would have started. Company may have created a provision, a part provision for this, not full, or the company may have disclosed this as a contingent liability. Okay, company may have disclosed this as a contingent liability. So can we say that this event or this existed during the reporting year? Answer is yes. Now let's suppose after 31st December, say on 15th of January, what has happened? outcome of this case has been given. Means this case has been decided, company lost the case. So if the company has lost the case, what is required then? Company will have to create a provision if the provision is not already created, or create full provision if the provision is partly created. Yes or no? Yes, quickly. Yes or no? If the company has lost the case, so company will have to create a provision. Yeah, book the liability. Yes or no? Yeah. So now company lost the case. So the final outcome is there on 15th of January. So when is this event taking place? After the balance sheet date. Correct. So when is this event taking place? After the balance sheet date. But in respect of this event which has taken place after the balance sheet date, can we say that there was some condition related to this matter, related to this event, which existed during the reporting year as at the balance sheet date? Can we say that or not? Can we say that? Quickly, over to you. What do you think? Can we say that? Yes. What about this? Devu says yes. Somya says yes. Sorry. Rohan is saying no. Rohan, can you tell me why no? Kirti, Almaz, Naina, they are saying yes. Rohan, any thoughts as to why you're saying no? Why didn't it exist as at the balance sheet date? Over to you quickly. Why do you think it's no? Deepika is saying yes. So why do you think it didn't exist in the reporting year? Quickly, quickly. Rohan is saying you tell. So what we can say is definitely it existed. Okay. So to me, it's a yes. It's not no. So we can say clearly this matter was going on. So how do we say it didn't exist? Yes or no? So you need to think about it and you need to tell me as to why it's still no. Because during the reporting year, the matter was going on. Company was into a litigation. Okay. So this facts around the matter were known. They existed with the company. So it's not something which has come up to the company after the balance sheet date only, for which the company was not aware of before the balance sheet date. So to us, it doesn't appear to be like that. Clear on this? Tell me quickly, clear? Now, in respect of this outcome, let's suppose on 15th of January when the outcome is seen. So company found that this matter involved an outflow of, let's suppose, 1 crore. So the provision of 1 crore will have to be created. But as we discussed, this provision will have to be created during the reporting year. So this provision will not be created on 15th of January. When do you create this provision? 31st of December. Okay. This is what you call as adjusting event, means for which adjustment will have to be done in the financial statements for the reporting year. And what is the meaning of that adjustment? Recognition and measurement. Okay. So that is what you define as adjustment. Clear, everyone? Any questions on this? Quickly, any questions? Over to you. Any questions on this? Tell me quickly. If you have any questions, any doubts, please let me know. Everyone, okay. So Rohan, can you please speak up? What is your query exactly? Quickly, I need to understand as to, what is it that you have understood so far? Yes, quickly, please speak up, Rohan.
Sir, I could not understand what is these conditions in these events.
Okay, so have you understood that there is an event which has taken place after the balance sheet date?
Yes, sir.
Okay, what is that event? What is that event which has taken place after the balance sheet date? Quickly, Rohan.
So that litigation one.
Okay, but that litigation got settled. Settled in the sense court has
Yes,
decided that. Okay.
result that came after
Yes, so
the
there is a
balance.
result. Okay, now what is the result? Tell me what is the result?
So they have lost the case.
Company has lost the case. Okay, now as regards this matter, was the company aware of that before the balance sheet date?
No,
Was
sir.
this case going on before the balance sheet date? Tell me.
Yes,
Yes.
going.
How do you get to know about it? That this was going on before the balance sheet date, or maybe as at the balance sheet date, this was known. I'm not saying the outcome. I'm saying this case. How do you get to know about it?
Through estimation.
No, so what will you estimate? There's no estimation which is required. You'll talk to the management. Number one, you look at the financial statements. In the financial statements, company has already recorded a contingent liability. So do you need some estimation? No, it's a fact. Yes or no? So do you need
Yes,
any estimate? No. So what do you estimate? Nothing. Yeah, it's a matter of fact. It's not an estimate, isn't it? If a
yes,
matter was going on, company was into a litigation, do we need to estimate this? It's factual, isn't it? Tell me.
yes, sir.
Tell me. Yeah. So now the accounting standard says that if there is any event after the balance sheet date, like this, we have an event after the balance sheet date on 15th of January, for which there is an evidence of conditions that existed before the balance sheet date or as on the balance sheet date. So what are those conditions? Have you now understood? Yeah. Tell me quickly, huh?
So that conditions that whether there is chance of winning or losing, that is the condition.
No, condition is the matter itself. Condition is the matter itself. Condition is not about there is a chance of losing or there is a chance of winning or not having any clarity. That is not the condition. Condition is that this matter which has come up, which the company has lost, whether this matter existed before the balance sheet date or not. That is what you call as evidence of conditions. Clear?
Oh, okay. So
Okay.
that matter against which the court case has been filed.
Yeah, of course. That can also be an evidence of the conditions. So it is not that the company has to get into a litigation. Maybe the company only was thinking about to get into a litigation or not. And maybe the litigation started after the balance sheet date and got, you know, this outcome also came after the balance sheet date. So idea is not that the litigation should have been going on. Idea is that was it known to the company at that point of time or not?
Yes, sir.
Okay. So can we say yes now?
Yes, sir.
Okay. Now, the moment we say yes, what does it become? It becomes adjusting event. It becomes adjusting event. Okay.
Yes, sir.
Clear? Okay. Now, Anil, can you please explain your query quickly? Anil, please go ahead. Anil, over to you.
Sir, can it be I'm confused regarding reporting period. Could you
See,
please
reporting
explain?
period is the period for which you prepare the financial statements. Okay.
Oh,
So you
okay.
prepare the financial statements from April to March. Yes or no?
Yes, sir.
So that is what you call as reporting year. Similarly, if you are required to prepare the financial statements from January to December, so that will be your reporting year.
Sir,
Okay.
in this case, you considered from Jan to December, right?
Yes.
Okay, sir. Thank you.
Okay. Anyone else? Any more questions on this? Deepika is asking, adjusting and non-adjusting events, both of them will occur after the balance sheet date. See, any event which will occur after the balance sheet date is a subject matter today, as far as this AS4 is concerned. Why? Because if you have an event before the balance sheet date, then of course you would record that. You would account for that in the reporting year itself. Yes or no? Yeah. We are now only thinking about those events which occur after the balance sheet date. Why? Because that you will not think whether to record that in the reporting year or not. That is where you will have to apply the requirements of AS4. Okay. Clear, Deepika, on this? All right. Now, let's look at some more examples. Yeah. For the adjusting events only. If let's suppose there's a fraud or some error which was there in the reporting year or even the years prior to the reporting year, and the management gets to know about those errors or fraud after the balance sheet date, but before the financial statements are authorized for issue. So they will also become adjusting events, right? Settlement after the end of the reporting period of a court case, the one that we just discussed. Bankruptcy of a customer, which occurs after the balance sheet date. Okay. Now, as regards non-adjusting events. Now, what are these non-adjusting events? So let's try to understand non-adjusting events. Once again, these are the events which would occur after the balance sheet date up to the date financial statements are authorized for issue. So please remember, our period for consideration of events, whether that is adjusting or non-adjusting, is same. Yeah. So now what is the difference in case of non-adjusting events? Difference is very simple. It says that if there is an event for which no condition existed as at the balance sheet date, unlike what we saw in case of adjusting event, no condition existed as on the balance sheet date, then you will call it as non-adjusting. Now, what is the meaning of non-adjusting? You will not adjust that in the financial statements for the reporting year. Okay, means you will not be recording that in the reporting year, but a disclosure for this event will have to be included in the financial statements for the reporting year. Okay, so non-adjustment doesn't mean that you will not disclose that. You will disclose. Non-adjustment simply means that you will not recognize that. You will not measure that. When? During the reporting year, in the financial statements for the reporting year. Now let's take an example for this one also. Okay. Say for example, just a minute. Say for example, once again we have this 31st December as the reporting year, 1st January to 31st December. Okay, now say on 1st of Feb, 1st of Feb, fire took place at one of the production facility. So company has various plants. in case of one of the plant, fire took place. Okay. And the plant is destroyed. Yeah. So if the plant is destroyed, assets, okay, machines, various assets which will be there, you will have to write off, or you will have to create a provision for all of those assets or not. Tell me, will that be required to be done? What do you think? Over to you. Will that be required or not? Yeah, Deepika says yes. What about others? So if let's suppose there's a loss, so well, that will be required to be adjusted or not? Devu is also saying yes. What about others? Quickly. So if let's suppose there's a fire, okay, because of which this destruction has happened, so will that be required to be recognized or not? Yes or no? Yeah. Kirti, Tanisha, they are saying yes. Now the question arises that this recognition that you do, okay, whether you record this in the reporting year, means whether you record this in the reporting year. For this, what do? You will go to AS4. And AS4 says that for this event, now this is an event which has taken place. For this event, you need to find out whether there was any condition. So now during the reporting year, as at 31st December, can we say that the company was aware of this fire to be taking place on 1st of Feb? Can we say that? Can we say that? What do you think? Somya says no. Yeah. Vimuri says no. We can't say that. So that means no condition existed for this event as at the balance sheet date. And the moment we say that the condition for this event did not exist as at the balance sheet date, what does it become? Non-adjusting event. So therefore, when do you record it? On 1st of Feb, not in the reporting year. But in the reporting year, the financial statements that you prepare, in those financial statements, a disclosure for this event will have to be given. Means company will give a disclosure that subsequent to the balance sheet date, before the financial statements were authorized for issue, fire took place at one of the plants which got destroyed, and because of which there is a destruction amounting to so and so. Yeah, again, depending on whether this amount is significant or not. Yeah, so this is not something again which you will be doing for everything. Again, that will be dependent on the materiality, the significance. Okay, so this is what you call as non-adjusting event. Okay, so Shiv is saying no because losses happen after the reporting year. That's correct. So Shiv is asking it will be reported in the next financial year. Yes. So this will of course have to be recognized. But when do you recognize this? When the event has taken place. Okay, means on 1st of Feb. Clear? Yeah, Shiv, clear on this? Okay. Everyone clear? So this was about adjusting and non-adjusting events. Okay, so now let's look at some examples for the non-adjusting events also. Destruction, I think the one we just discussed. A major business, let's suppose an acquisition of business has taken place. Abnormally large changes in the asset prices or foreign exchange rates. Material non-adjusting events. Okay, it could be any other event which is non-adjusting. Yeah. All right. So now As regards adjusting and non-adjusting events, I think we have already looked at some examples. Okay. Now what we will do is we'll just look into some more examples and we'll try to get into the accounting requirement also. Okay. So let's look at this example first. Okay. We are continuing on the same principle, in fact. Okay. So Rohan has a question. Rohan is asking, sir, if we were aware that fire may occur soon, then it is no. So fire is not something that you will be aware of. That it may occur. So how can you say that you are aware of this and still you let the fire to take place? That is not logical. Clear? Yeah. So of course you can say that company has a risk, that because the nature of activities are such, so there is always a risk of fire. But to say that the company knew about fire taking place and still let the destruction happen, that is not logical, huh? Okay, that is not appropriate. Yeah. So that's how you will not be looking at everything. If let's suppose, say there is an earthquake, so can we say that the company knew about the earthquake? No. But can we say that the company will be considering such risks? Always. Yeah. So any business will be considering all of those risks. Okay. Harshda is asking, can the insurance for plant become a provision? So I'm not clear on this. Harshda, can you please elaborate on this? What exactly is the query? Over to you. Yes, Harshda, please go ahead with your question. Please pick up.
So my actually concern is when we are like for life insurance also we are taking for our life we are also taking insurance. So like that we can companies are also taking insurance for plants or like buildings and lands like. So can the means can we call it as a provisions for this occurrence?
Okay, so let's try to understand about this. If let's suppose company is taking a provision, okay, let's suppose, sorry, a company is taking an insurance. Yeah, so say there is this financial year, 1st January to 31st of December. So management will always be looking at various types of risks which may arise in the business. So therefore, what did the management do? On 1st of January, they took an insurance. Or let's suppose on 10th of January, they took an insurance. Okay. Insurance was to cover against any risk of fire which may take place in future. So what is the period which they have covered? This 1st January to 31st December. And let's suppose they have paid a premium of rupees 50,000. Now, tell me whether this event or whether this transaction is the one which is taking place after the balance sheet date. Tell me, is this the
No.
one? No. So will this fall under the purview of AS4? No. Correct? Ashda, clear on
Yes.
this?
Yes.
Number one.
Yes.
Now, coming back to your question that, okay, fine, it's not within the scope of AS4. So when do we record this? So you'll record this as and when you will incur the expense. So when do you incur this expense? On 10th of January? Yeah. So do you record this as an expense? Answer is yes. Do you need to create a provision for this? No, because it's an actual liability. It's an actual liability. So no provision is required. It's an actual liability. You will record it as an expense. Clear? Ashda, clear on this?
Yes, sir.
Okay.
Because these are expenses, so we'll book as a expenses because we are incurring that.
Yes. And as and when you incur, you will record it.
Okay. And in such cases, if you are not taking insurance, then in such cases, this AS4 will means. will be
No,
there.
no. So even if, let's suppose, insurance is taken, let's suppose in the similar case, let me just extend this. Let's suppose company had taken insurance, okay, and the insured amount was, say, for example, rupees 5 crore. Let's suppose that is the sum assured. Fine. Now company has been taking this insurance every year, but now what has happened on 1st of Feb next year? What? Okay, so let me just also specify the year. So this is 1st January 2024. This is also 2024. On 1st Feb 2025, fire took place. Okay, and there was a destruction of one of the plants. Yeah, and this destruction was for rupees, say, 11 crore. So now company has lost its asset worth of rupees 11 crore. Now the question arises that for this loss of 11 crore, when should the accounting be done? Now tell me, Hashta, when will you record this loss of 11 crore?
Okay. So this is happening after the certain the insurance period, right?
It's not about after the insurance period.
Okay, the reporting period.
It's happening after the reporting period. Okay, so next year is also
Okay.
insured. Every year company will take the insurance. So next year also is insured. Okay, problem is
Okay.
not whether the next period or the current period is insured or not.
Okay.
Problem is this event is taking place after the balance sheet date. For which, do you have any condition existing as on the balance sheet date? No.
No.
So, will you record this on 1st of Feb? Answer is yes. But for this event, which you will record on 1st of Feb, a disclosure will have to be given in the reporting
Okay.
year.
Okay.
Okay. Now,
Okay.
whether
So
it is
yeah.
insured or not insured, does it matter? No. Why? Because if,
No.
let's suppose, this is insured, so the company will book a loss of 11 crore.
Right. That event has took place, so we have to mention in the financial statements, right?
Right. Right.
Disclosures.
Right. So
Okay.
your accounting requirement for insurance or claiming the insurance amount, all of these things are de-linked to what we are discussing now. Clear?
Okay. Okay. Thank you, sir.
Sure. Okay, so then I can see one query for Rohan. So Rohan is asking, sir, can we say that all uncertain events that occur after? Yes, of course, we can say that. Uh, okay, please pick up fast. Yes. Yes, tell me.
Yes, good morning, sir.
Good morning.
Sir, my voice is clear, no?
Yeah, yeah, clear.
Okay, sir. So I was asking that instead of fire, an example
Yes.
is also given for destruction due to fire. Let us suppose it is flood and it was raining from December starting or November ending. So it was by weather forecast. They have said that the flood may occur. So it is certain, no? So for this disclosure will be made of provisions.
Okay, so let me just change this. Huh? So it's a good example. Huh? Very good. So let's suppose instead of fire, there is a flood. Yeah. Flood is again a natural calamity.
Yes, sir.
Yes or no? Now, once again, the point is very similar that for this flood, okay, which has taken place, say, on 1st of Feb, can we say some condition existed? Answer is no. See, one is to think about that risk, that if you look at the businesses, okay, so every business will always be looking at various types of risks which may arise in future. Just because it is raining heavily, to say that we are sure the flood is going to occur may not be appropriate. Yes or no? Yeah. So that is not a condition for a flood to occur or an evidence of such condition as at the reporting year. Okay. So there again, it's a natural calamity. It can occur at any point of time. So the company is not aware of that during the reporting year. Understood? or maybe the destruction this flood will close. Company is not aware of that during the reporting year. Clear?
But the company is aware by weather forecast that they have told that it may occur in few months, in next months.
No, so that is something which will always be going on. That is something which will always be going on. Okay. And as regards this flood, problem is not the flood. Problem is about the destruction this flood will cause. Because you will not be required to record the flood in the books of accounts. Let's suppose this flood has caused a destruction of rupees 11 crore. That is what you will have to record in the books of accounts. So let's suppose if you want to create a provision. Okay, so in such a case, what do? You may be thinking that, okay, on 31st of December, let's create a provision because the flood is expected to occur. So that's what you'll do, ideally then, isn't it?
Yes, yes,
Because you are saying that because it's raining heavily, so that's why company is estimating flood is going to occur, and this flood will lead to a destruction of rupees 11 crore. So should we apply the requirements of AS 29 then? That's how you will have to think about it. So can we say that the company has incurred such expenditure? So if I go by that rationale, should the company not be doing that? Tell me,
yes, sir.
yes or no? But which may not be appropriate. Now clear on this?
Yes, sir.
Okay,
Yes, sir.
sure. All right. Any more questions? Yes. Anyone else? Okay, so let's look at this example. A company follows April to March as its financial year. Company recognizes checks dated 31st March or before received from the customers after the balance sheet date, but before the approval of financial statements by debiting checks in hand and crediting the debtor's account. Checks in hand is shown in the balance sheet as an item of cash and cash equivalent. All the checks in hand are presented to the bank in the month of April and are also realized in the same month in the normal course after the deposit in the bank. Even if the checks bear the date 31st March or before, checks received after 31st March do not represent any condition existing on 31st of March. Thus, collection of checks after the balance sheet date is not an adjusting event. Now, this is an important point, that collection of checks after the balance sheet date is not an adjusting event. Recognition of checks in hand is therefore not consistent with the requirements of AS4. Moreover, collection of checks after the balance sheet date does not represent any material change or commitments affecting the financial position of the entity. And so, no disclosure of such collections in the director's report is also necessary. It should also be noted that framework for preparation and presentation of financial statements defines assets as resources controlled by an entity as a result of past events from which economic benefits are expected to flow to the entity. Since the company acquires the custody of the checks after 31st March, it does not have any control over the checks on 31st of March, and hence checks in hand do not qualify to be recognized as asset on 31st of March. Clear? Yeah. So now, idea to discuss this example is just to give you this clarity that when we talk about this, when we are talking about this indicative of conditions, okay, so you should not be thinking about just any condition. For a check, you can always say, but we had a debtor, we knew the amount has to be collected, and the party was, or maybe the company was having discussions with them over call on a daily basis that please send my payment, please send my payment, and that's why this check has been received, so that's why it should become an adjusting event. Okay, so that's not how you will be looking at the adjusting events. Otherwise, every event you will call as adjusting event only. and thereby everything which will take place after the balance sheet date up to the date financial statements are not authorized for issue, you will end up recording entire such period in the financial statements for the reporting year. Okay, which is not correct. Clear on this, everyone? Everyone clear on this? Yeah. Okay, so then I think we can look at one more example. Okay, there are few examples. Okay, sure. So let's look at some small examples. All right, so now in X company limited, theft of cash of rupees 5 lakh by the cashier in January 2000 X1 was detected only in May X1. Yeah. So we are looking at the financial year now. Financial year means April to March. Accounts of the company were not yet approved by the directors. Means when the theft has been detected in May, financial statements were not yet approved. Decide whether this theft of cash will be an adjusting event or not. Over to you. And why? Yes. Should this be an adjusting event or not? And why? Over to you quickly. I think Shiv has a query. Shiv, I'll just come to your point. So in this case, will you call this theft as an adjusting event or not? Quickly, over to you. Everyone. Okay, Ron says non-adjusting event. All right. Devu says adjusting event because it has evidence before the reporting date. Then I think she's saying adjusting event as the event had taken place in the reporting year. Okay, what about others? Quickly, Priyanshi says amount to be recognized as before approval date. So it is adjusting. Prem says adjusting event because the theft had happened in the financial year. Very good. So in this case, when did this theft take place? During the reporting year. Yeah. It's detected after the balance sheet date. So that means for this event, was there an evidence of conditions as at the balance sheet date? Yes. So that's why, what does it become? Adjusting event. So when do you record this? So this loss, when do you record this? During the reporting year ended 31st March X1. Clear? So I think Shiv has a query. Yes, Shiv, please go ahead with your query. Shiv, you raised hand. Do you have any query? Yes, Shiv, please go ahead. Yes, Shiv, quickly, huh? Please pick up fast.
Sir, my query is,
Yes.
when check will credit to company account after 31st March?
Okay, you're talking about the previous example in respect of checks in hand?
Right, sir.
Yeah, so you'll record them when the company will receive that.
So on 31st March, company will
If the company
show
receives on
outstanding of
31st
debtors.
March, no, so if the company receives on 31st March, then the company will record on 31st March. If the company receives, let's suppose on 1st April, then next year they will record it.
But if company record record on 31st March and check will be dishonored, then what will be the treatment, sir?
So that's a separate thing. Huh? So two things are completely different. See, one is to record the checks in hand, and checking and dishonor is a, so there are two, you can say, sort of events which are taking place. So let's discuss about both. Okay.
Yes.
Now let's suppose we are looking at, let's suppose, financial year ended 31st March 2025. Okay, 1st April 24 to 31st March. Okay. Now, say the company received the check on 31st March. That's what you're saying? Quickly. Shiv, that's what you're saying? Company received the check on 31st March? Shiv, you're there? Shiv, you're there? Shiv, please pick up fast. You're there?
Yes, sir.
Okay. So the company received on 31st March. That's the situation you want to discuss?
Yes, sir.
Okay. So now the company received check on 31st March. So therefore, when will this be recorded? This will be recorded during this reporting year. Obviously. Why? Because when the check is received during the reporting year, you will record that in the reporting year. Now, next point arises that check gets dishonored. Okay.
Yes.
Now here again, we need to look at our event. So for this event, let me just place this as the cutoff. So say 31st May is the date when the financial statements are going to be authorized for issue. Okay. So this is the approval date. Okay. Now there are two situations which are possible. One, the check is presented and got dishonored after 31st of May. Now, will you be considering that if that happens after 31st May? Tell me, will you be considering that? Shiv, what do you think?
I think if we can, accounting standard allow us, we cannot record it.
No, so whether the accounting standard allows or not, that is what you need to answer now. After 31st May, after 31st May, do you see this? Do you see this dishonor taking place after 31st May or before 31st May? So we are saying that it is taking place after 31st May. Okay, so that's the first situation I'm creating, that this is taking place after 31st May. Now, the event which comes after the financial statements are authorized for issue, do you consider them?
No.
No. So that means this part will not be relevant for us. Okay. So if the check gets dishonored after 31st May, you will have to ignore that event. Now let's suppose check gets dishonored, say on 30th of April. Okay. Now, is this event taking place during the period which we need to consider as per AS4? Yes or no?
Yes, we can.
Yes.
We can.
Now for this event, we need to check whether there was any evidence of condition which existed on the balance sheet date. We find yes. So this check existed as at 31st March. So therefore, if this gets dishonored on 30th April, so the accounting entry for dishonor you will do in the reporting year.
Okay.
Clear? Yeah.
Okay, sir. Yeah.
Clear? All right. So let's look at some more examples. Rohan is asking, sir, in illustration 1, it's not an event occurring after the balance sheet date. No, it's an event occurring after the balance sheet date. You please look at the question carefully. Yeah? So it's an event which takes place after 31st March. Okay. All right. So next example. So we'll discuss some more examples through which you should be getting more and more clarity. Now, next example. An earthquake destroyed a major warehouse. For this company on 20th May X2. Accounting year of the company is ending on 31st March X2. So again, we have the financial year. So this earthquake has taken place after the financial year. Accounts were approved on 30th June. So can we say that this event is falling within the purview of AS4? Answer is yes. The loss from earthquake is estimated at rupees 30 lakhs. State with reasons whether the loss due to earthquake is an adjusting or non-adjusting event and how the fact of loss is to be disclosed by the company. Over to you, quickly. I think it's a simple one. Quickly. Quickly, how do you deal with this? Prem, I'll come to your query. How do you deal with this? Over to you. Okay, Devu says it's a non-adjusting event as the indicative conditions occur after the balance sheet date and loss needs to be disclosed. See, this disclosure that you do, this disclosure you will do in the director's report. Okay. Rohan is saying disclosure will be required, means non-adjusting event. Okay, Almaz is saying it's non-adjusting event, disclosure is required. Priyanshi says non-adjusting, great. Somya says non-adjusting. Ashda says non-adjusting. Kirti, I think everybody has the same answer. Okay. Julie says non-adjusting. All right. Now, see, it's as we discussed, it's non-adjusting. So therefore, what do you need to do? Just give me a minute. So therefore, this will not have to be recognized in the financial statements. But yes, a disclosure for this event will have to be done. And where do you do the disclosure? So the disclosure, again, if the amount is very, very significant, you get onto the financial statements also. But as per the requirements of the accounting standards, you will do that in the director's report. Director's report is the report of the approving authority. Okay. Now, next example. A company has filed a legal suit against the debtor from whom 15 lakh is recoverable. Chances of recovery by way of legal suit are not good as per the legal opinion given by the council in April X1. Now, can the company provide for full amount of provision of 15 lakhs during the reporting year? Now, what is the reporting year? Year ended 31st March X1. So the point is that should we say that it's an adjusting event or not? Over to you, quickly. Should we say it's an adjusting event or not? Tell me quickly. Is this an adjusting event or not? Okay, great. I think Devu, Anil, they are all saying it's adjusting event. And what makes you say it's an adjusting event? So what is the event which is taking place after the balance sheet date? Tell me. So the event which is taking place after the balance sheet date is the legal opinion received from the council. Okay, it's not the result of the case. It's the legal opinion received from the council after the balance sheet date. Okay, yeah. Anil is saying winning chances. No, we do not have winning chances here. We have losing chances here. Clear? Okay. All right. So therefore, this provision will have to be created in the reporting year itself. Next example. In preparing the financial statements of R Limited for the year ended 31st March X1, you come across following information. State with reasons how will you deal with that. Company invested 100 lakhs in April X1 before the approval of financial statements by the board of directors. Okay, and why did the company invest? So company is acquiring another company doing similar business. Negotiations for which had started during the reporting year itself. Now tell me, what do you do? Is this an adjusting event or not? I think we discussed this. Okay, Somya says provision has to be created. Why a provision? We are talking about investments. Rohan says adjusting event. Almas says non-adjusting. Mohammed says non-adjusting. What do you quickly? Just think about it carefully. For everything, you should not say a provision has to be created. It's an investment. So what is the matter of provision here? Mohammed says non-adjusting. Jendra says non-adjusting. Okay, no worries. Huh? Okay, so I think Somya had this answer for the previous one. No worries. Devu, Harshda, they are saying non-adjusting. Okay. So this is an event which is taking place after the balance sheet date. What is the event? Investment means acquisition of the business. Yeah. Acquisition of another company is an event occurring after the balance sheet date. Clearly? Yeah. However, no adjustment is required. Why? Because event doesn't affect the determination and condition of the amount stated in the financial statements for the reporting year. However, disclosure will be required. The moment you say non-adjusting, disclosure will be required. Where do you disclose? Approving authority. Yeah, so that means the director's report only. Yeah, and considering the significance involved, yeah, so you also get onto the financial statements for such disclosures. Okay, but can you tell me when will you record this transaction? So of course it's non-adjusting, but when will you record this transaction? Over to you. As regards this transaction, when will you record this? Quickly. So when should this transaction be recorded? Great. Jendra says on the investment date. So that means in the next year. Okay. So non-adjusting doesn't mean that you will not record that ever. Yeah. So as and when the transaction will take place, you will record it. Clear? Clear? Everyone? Okay. Then I think she is. No, so I think you need to elaborate on this. Can you please go ahead with your query? Can you please explain what's your query? Over to you. Yes, please go ahead.
Sir, I was asking that if the contract has been finalized in the reporting year itself, then
Right.
we will consider as adjusting, sir.
No, so what is the meaning of contract is finalized? So how do you define the finalization of contract? So that is something you'll have to look at. Okay. Now, finalization of the contract, does it imply that the investment is made? Because when you are saying company has invested, okay, so that means a contract is getting. What is the meaning of investment? You go acquire the shares. So what will you do? You will get onto the discussions. Okay, you will agree on the amount. Once the amount is agreed upon, an agreement will be executed. And once the agreement is executed, then of course the payment will have to be made. But we are not waiting for the payment to be made. We are just talking about the final settlement between two parties, which is nothing in the form of an agreement. Okay, so the moment you say agreement is finalized, that is nothing but an investment only. Clear? So that's how this process will have to work. Clear on this?
Like, sir, I have entered into a binding agreement telling that
Yes.
in 10 days I'll make the payment.
So
So,
see, whether you make the payment today or after 1 year or maybe after 3 months, Let's not go by that, because which method of accounting do we follow? Cash basis or accrual basis?
Accrual.
Accrual. So that means whether the payment is made or not made, that should not be the only consideration for you to record this. Understood? Maybe
Yes.
two parties have agreed, they have finalized everything, they have signed off the agreement. Okay, the deal is all done. Only the payment is outstanding. So you'll not wait for the payment to happen. So you'll say, yes, everything is in
Okay.
place. It's an investment by the company. Yeah.
Yes, sir.
Or
Yes.
maybe the part payment is made, the remaining part payment has to be made in future, which is then again okay.
Okay, sir. Understood.
Okay.
Thank you, sir.
Sure. Okay. So then I think Ron is saying date of agreement. Yes. See, generally that's how you will decide whether the agreement is finalized or not. And what is it that you need to look into this investment also. Okay. So all of these documents, etc., whether they have been signed off. Payment again is going to be important. So it's not that the payment is not going to be important. So that is again important. But at the same time, you also need to look at as to whether the deal in all respects is finalized or not. Okay. Yeah. All right. Clear, everyone. I think Prem had a query. Yes, Prem, please go ahead with your query. What's the question? We can discuss that now and then we'll take a break. Huh? Okay. So any questions, any doubts? If you have, over to you quickly. Yes, Prem, please go ahead. Please explain what's your query. Please pick up fast. Yes, Prem. You can just raise hand. Huh? And then I think somebody will unmute you. Prem, please go ahead quickly. Waiting for you to explain your query. Okay, so no worries. Huh? So let me just go through your query and just help me understand if I have understood that correctly. So his query is, if the company put fire for doing fraud. So what is the meaning of company put fire for doing fraud? To claim insurance. Okay, so we are saying it's a fraudulent activity on the part of the company. So the fire has taken place, but it was not natural, but the company did this on their own. If there is any loss or profit. So once again, the point is not whether this fire took place on its own or somebody did that. The destruction has happened. So if the assets are destroyed, you'll have to create a provision or not. Yeah. So the intent doesn't matter in this case. Whether that is by mistake or fraudulent, both the things you'll have to understand. And in this case, yeah, because this event has occurred, so that's why you'll have to call it as non-adjusting only. Then I think Rohan has a query. Yes, Rohan, please go ahead. I'm just
Sir,
hoping, Prem, you're clear. Yes, go ahead.
illustration number 4, it should be an adjusting event, isn't it?
No, so we discussed it's not an adjusting event, it's non-adjusting event.
Sir, because the negotiations had started during the year, so conditions existed now in the reporting period.
No, so see, negotiations had started, but we are not clear on the outcome. Okay, and that's what I told you, that if this is how you will be looking at all these things, okay, or all these events. So for every event, you will be able to, look into any aspect that, of course, if there is anything related to the business transaction, You'll say it's related to the business. So in the business, something must be going on, something they would have been discussing. So negotiations, all of these things are what? They are all discussions. Okay. Discussion is not a conclusive evidence, you can say, whether this these deal with get through or not. So that's not how you will decide it. Clear?
Okay, sir.
Yeah. Otherwise, what will happen? You will end up recording your subsequent period in the reporting year only. Okay.
Yeah, sir.
All right. Okay. So any more queries if you have? So I think Prem is clear. Very good. Okay. So let's take a break now. Yeah. So let's continue after the break. So Manish, we can take a break now. All right, so let's continue. So let's pick up one more example. Okay. So now the next one, a company closed its accounting year on 30th June. Okay, so please remember reporting date is 30th June X1. And the accounts for that period were considered and approved by the board of directors on 20th August. Okay. Company was engaged in laying pipeline for an oil company. While doing the boring work on 1st of September 2000 X1, it had met a rocky surface for which it was estimated that there would be an extra cost to the tune of 80 lakhs. So how will you deal with this transaction for the reporting year ending 30th June X1? Over to you. So is this an adjusting event, non-adjusting event? What is your thought on this? Over to you. Asta, I'll have to come to your queries. Yeah, maybe let's discuss this and then I'll come to your query. Huh? Quickly. So how will you deal with this situation? So do you call this as adjusting event or non-adjusting event or whatever do you do? What's the reason? Yes, quickly. So how will you deal with this? What do you do in this case? Mohammed is saying, sir, we have to ignore because the event occurs after the financial statements are approved. Okay, very good. I think same is the response from Almaz. So this is a situation which you will not call as adjusting or non-adjusting. Now this is important. Huh? Why? Because if you call this as non-adjusting event, so that means you have considered this to be within the purview of AS4. Okay, but that is incorrect. So this event is not covered within the purview of AS4. Yeah. So this is 30th June X1. Okay. Then the financial statements, they are saying they will be approved on 20th August. So anything that falls during this period, okay, that is where AS4 will apply. And this could be adjusting or non-adjusting. After that, will AS4 apply? No. So if you have event after that, will you call it as adjusting or non-adjusting? Nothing. You will say it's outside the scope of AS4. Okay. Clear on this? Everyone clear? Then I can see one query coming from Astha. Okay, great. Yes, Asta, please go ahead with your query. What's your query? And then we'll move on to the next accounting standard. Yes, Asta, please go ahead with your query. Over to you quickly. Yeah, please pick up fast. What's your query? Please explain your query. Manish, can you please unmute Asta? Yes. Yes, Asta. Asta, you need to speak up fast, please.
Yes, sir.
Tell me what's your query?
Sir, if suppose company is warned by the officers but not taken the proper measures,
No, so you
and
need to explain your query. Huh? What is the meaning of not warned by the officers or warned by the officers? So what's the context? Please explain, huh? So that everyone can understand your query.
sir, if suppose electricity department has warned some kind of issues that can be occur in future, so you need to
Okay.
replace some wires or so, but the company doesn't take it and the destruction happened in future.
Right.
So that will be adjusting or non-adjusting?
That will be non-adjusting event, because if let's suppose you are talking about fire, okay, so fire is not something which you will expect, or you'll say conditions existed for that. Yeah, so that will be non-adjusting event.
Okay, sir. Sir, bankruptcy of customer.
Yes,
Why it is adjusting event?
you tell me, should this be adjusting or non-adjusting?
Sir,
If let's
non-adjusting because
suppose,
we
let me
don't
just,
know about the customer bankruptcy beforehand.
no, which is fine. So let's suppose there's a customer from which the company has a receivable of rupees 10 lakhs. Okay, on 31st March, there's a receivable of 10 lakhs. Now, two situations are possible. Company may have created some provision or may not have created a provision. Okay, in both the cases, company finds that on say 15th of March, sorry, 15th of May, this customer got bankrupt. Okay, financial statements will be approved on 31st of May. So now in this case, on 15th of May, when this event has taken place, in respect of this event, did the company had an outstanding balance in respect of this customer as at the balance sheet date or not?
Yes, sir.
Yes. So that's why, what do you call it as? Adjusting event. That's why this event or the impact of this event you'll have to consider in the reporting year, and you'll have to create a provision for rupees 10 lakhs.
Okay, sir.
Okay.
Yes,
Clear?
sir. Sir, I have some queries from AS15.
AS15. So let's do one thing, that once we are through with this, okay, towards the end, we'll discuss that. So once we are through with today's session, then we'll discuss your queries. Okay, related to
Okay.
any other topic, we can do that. Huh? Fine.
Okay, sir.
All right. So now what we will do is, just a minute. Now, just a minute. Let me just open the presentation. Just give me a minute. Okay, so the next accounting standard we are picking up is very simple. This is all about profit or loss, the way you present that, I would say, in the financial statements. That's one. It talks about a very interesting concept of prior items, and it also talks about estimates accounting policies. I think estimates accounting policies, to a certain extent, you are familiar with that, but we are going to discuss that in more detail. Okay, now, as regards this net profit or loss for the period. So the standard talks about certain things. Okay, net profit or loss for the period. Now we are aware of this as to what is net profit or loss for the period, correct? So this is something which you get in the statement of P&L. Now, in relation to this net profit or loss, one is your profit or loss which you get from the activities which you can say are the core activities. Okay, or which you can say is which is in the normal course of business. Yeah. So any profit, any loss which is generated by the entity in such a scenario, what do you call it as? From ordinary activities. Yeah. For example, a company is in the business of, say, trading of furniture. So during the year, if the company has generated some profit, okay, from the sale of furniture. What do you call it as? Profit from ordinary activities. Yeah. Why? Because that's the core activity. You can say that's the main business. Yeah. So that's how you look into it. Rohan is saying, can we say operating one? Yes, of course. That's nothing but the operating one only. And in fact, that's how you will be defining that. Clear? So I think this part is not really new. This is quite common for you. Next term, extraordinary item. Now this is important term. Now what is extraordinary item? Here again, we are talking about income or expense. Means, once again, we are talking about P&L items. Okay. Now, during the year, what may happen is there is an income or there is an expense or there is a transaction resulting into income or expense. Okay. But such events or transactions which generate such income or expense, they are clearly distinct. Now, please remember, they are clearly distinct from the ordinary activities. Number one. And so, what is the first criteria? They are not arising from the ordinary activities, and they are also not recurring in nature. So, they are not expected to recur frequently or regularly. Okay. Yeah. Now, if you have any such transaction which is resulting into income or an expense, it could be either way. So what do? You will call it as extraordinary item. Will that be recorded? Answer is yes. Will that be recorded in the P&L? Answer is yes. But in the P&L, when you record it, it is required to be presented as a separate line item. Okay, so in the statement of P&L, there will be a separate line item for extraordinary items. Yeah, so that's the only requirement. You can say that's the only change. So as far as recognition is concerned, as far as measurement is concerned, there is no change. So what is the only change? That such items, for such items, the nomenclature will be extraordinary and they will have to be presented separately. Number one. Number two, because these are sort of unusual, non-recurring, distinct from the ordinary business activities. So that's why when you present separately, then you also give a disclosure around that. So therefore, nature, amount of such items, one, of course, you will present separately. You will also be giving a disclosure around it. Okay, so this is about the presentation. This is about the disclosure. Okay, so that's the requirement that we have around the extraordinary items. Okay, now the question arises as to what could be the examples for this. Say, for example, and that has resulted in some loss to the company. Okay. Now you may be thinking, but sir, in that case, will AS4 not apply? Yes, so that's a separate consideration. So we are now not talking about AS4 as to whether this is the event after the balance sheet date. No, so we are not talking about it. So we are just talking about if there is an event or a transaction, how do you record it? How do you present it? How do you disclose it? Okay. Similarly, if let's suppose there's attachment of property of the entity. Yeah. So any losses which are sustained by the entity, that's how you will be presenting them. Next, there is another concept which is called as exceptional item. Now let's try to understand this concept as well. Because generally, there is a confusion. between extraordinary item and exceptional item? Priyanshi, I'll come to your query. Huh? I was just waiting for this question only. I'll come to your query. Okay. Now, what is this exceptional item? Here again, we are talking about items of P&L, means transactions which will result into income or expense. Okay. Now, when the items of income or expense within the P&L from the ordinary activities. Now, please remember, now we are not talking about activities other than ordinary. We are talking about ordinary activities only. But their size is such, their nature is such, okay, that their disclosure is important for the understanding of users of financial statements. Generally, these are of a very significant amount, or you can say their nature is very, very important. Their understanding is very, very important for the stakeholders, for the users of the financial statement. So that's why standard requires that such items should also be presented separately. So when you present them separately, what do you call them as? Exceptional item. And when you present them separately, you also give a disclosure for the same. Now, what could be an example for this? Say during the year, fixed assets have been disposed of and it's a significant amount. Long-term investments have been disposed of. Again, when the amount is significant. Okay. Any litigations got settled, significant amount. If there is any write down of inventory to NRV, or if there is any reversal of provision of inventory. So all of these are what? They are examples of exceptional item. Now for the exceptional, for the extraordinary items, as we discussed, for both of them, separate presentation is required in the P&L and disclosure is also required to be included in the financial statements. Okay. Everyone clear on this? Any questions on this? Quickly. Any questions on this? Quickly, any questions, any doubts if you have? Rohan is saying where to disclose in the notes to accounts. Okay, so this disclosure will be given in the financial statements, in the notes to accounts. Yeah. So disclosure is all about explanation. So you'll explain the nature of transaction, amount involved. So that's what you'll do. Okay, clear? Then I think Priyanshi has a query. Priyanshi, can you please explain your query? Over to you quickly. Priyanshi, can you please explain your query? Yes.
Yes, sir.
Yes,
So
please
I
explain.
was asking about that in the say in exams the is given. So
Right,
we will apply the accounting standards, the particular accounting standards which is applicable over here, because we have seen in AS4, AS5, and all about these subsequent events, prior period items, and also these are so similar.
right.
So somewhere we are tend to confuse that which standard we have to apply.
Okay, no worries. So see, there are a couple of ways you will understand about it. One, the question will specify. Okay, question will specify as to what is it that they are going to look at. Now, if the question is talking more about the subsequent event, then you will get to know about it. For example, if we say question says that during the year there's an earthquake, reporting year is 31st March, earthquake was there, let's suppose on 15th of May. And the question is also giving you an information that the financial statements for the company are going to be authorized on 30th June. It's giving you all the fact pattern for your accounting requirement related to AS4. That's one. Yes or no?
Yes, sir.
Number two. Now you may be thinking that's fine, sir. As per AS4, we can always say it's non-adjusting event. So the question may also ask you whether it is adjusting or non-adjusting event. That's one way. If you say no, the question is only asking about the accounting treatment. Okay, fine. Now the next question will be that you will say will answer that this is non-adjusting event. So that's why you'll have to record this in the report in this particular reporting year. Let me just put down the year also. So this is 31st March 24. This is again 24. This is again 24. So you'll say that, sir, while answering this question, I'll have to write down that this will have to be recorded in 24, 25. Okay, that is also good. Now, the next part is that because this transaction is such that you find this transaction to be in the nature of extraordinary item, right? So you are saying that, okay, we will record this in 24, 25. Now, only one liner you need to add. So what will you say? That while recording this in 24, 25, you will present this as extraordinary item and disclose this in the financial statements. Simple. One more line item you'll have to add. That's it. Yes or no? Yeah.
Yes, sir.
Why? Because in this case, you understand there's an application of AS5 as well. So that should not be a problem. See, if you are clear on the concept, if you know the answer, then you can always add for both. Again, you'll have to look at the weightage, you'll have to look at the specification of the question. So the question may ask you that answer this within the light of AS4. If the question is silent, question may be asking you the accounting treatment from the perspective of adjusting, non-adjusting. If the question is silent on both of them and you find that two standards are going to apply, then you need to answer for both. Again, depending on the weightage. Okay,
Yes,
clear?
there can be one more standard, that is accounting standard 29, contingency.
No, so how will that get applied here?
No, that in AS4 we are seeing the certainty and uncertainty of that contingent event. Means contingency is
Yeah,
seen
which
in
is
AS29, but
no. So there again, so for a particular question, you will have a situation wherein maybe one or two accounting standards will apply. You will not see that for a particular transaction, three or four accounting standards will apply. I cannot think of any transaction over which you will see a lot of accounting standards will get applied. No, that's not how things are going to be there in the exam. Okay, so that is not something which the expectation is there from you. So don't worry about it. Okay. And in
okay,
fact,
sir.
you will get more clarity around it. I can understand your query, and your query is very good. In fact, I was just waiting for this. Huh? That's why I told you that there could be a confusion as to whether you go to AS4 or AS5. This confusion of your will automatically get over once you start practicing questions. Okay, so what we are doing right now is we are discussing the concepts. We are also discussing the questions. But when you attempt all of these questions on your own independently, okay, without any sort of this discussion that we have been doing, you'll start getting confidence. You'll also start getting a feeler as to how the questions are framed, what is how the answers are required to be given. So go through the study material, go through these past year question papers, you'll get a perspective around it. Okay, and that's how you'll get the confidence also. Clear?
Yes, sir. Thank you.
Sure. Okay, so now next concept. So we'll discuss some questions around this extraordinary, exceptional also. But let me just pick up one more concept and then we'll start picking up the questions around all of them. Now, the next concept is about prior period items. Now, what is a prior period item? Prior period item means any mistake which has taken place in the previous period or previous periods. Number one. This mistake could be intentional or unintentional. Intentional means it's a mistake, error. Unintentional means you'll call it as a mistake or an error. Intentional means you'll call it as fraud. Okay. Third, this is impacting the P&L. This is impacting the P&L. Fourth, amount should also be significant. Yeah, so it's not about an error for rupees 100 or for rupees 200. No, we are not talking about it. Yeah, okay. Once you have these criteria fulfilled, this is what you call as prior period items. Now, how is this required to be considered? How is this required to be accounted for? Let's take a very small example to discuss this. Say we are looking at 2024-25. Okay, in 2024-25, accountant was doing the accounting, he was preparing the financial statements. Okay, and he came across an error. So he found that in 2022-23, there were certain items of inventory over which there was some valuation error. It was unintentional. Maybe it was arithmetical error. Okay, maybe the totaling was incorrect. Any sort of error was found. So this error pertains to which period? 22-23. And when was this found? In 24-25. So now, what is the amount of this error? Say rupees 25 lakhs. So this amount is considered to be significant. Now, financial statements for 22-23 are closed. 23-24 are also closed. So can you change that? No. So therefore, this error needs to be rectified or not? So when do you rectify this? You will rectify this in the financial year 24-25. So when will you make the adjustment for this error? In the reporting year 24-25. Okay. When you will record this, so what do you call this as? Prior period items. You will call it as prior period item. So this prior period item, once again, when you record this in 24-25, so 2 points you need to consider. One, this will have to be presented separately. Okay, so there is a separate presentation requirement in the P&L for this. And for this one again, a disclosure will be required in the notes to account. So in the disclosure, what do you write? You'll write an explanation. The nature of this error, why this error had taken place, the amount involved, okay, impact of this correction that you have done in the current year. So how the P&L is impacted when you have adjusted this in the current year. Okay. Clear on this? Clear on this prior period item? Everyone quickly clear on this? Any questions on this? All right, so now let's pick up one example. Okay, so I'll just pick up one example to discuss this. All right, so let's look at this example. Fuel surcharge is billed by State Electricity Board at provisional rates. Yeah, in fact, it's a very common practice in case of State Electricity Board. Okay, so that's how they do this. Provisional basis means final rates were not there, so provisional rates they picked up, and that's how they did the billing. Final bill for fuel surcharge of rupees 5.3 lakhs for the period October X1 to September X7, so many years are involved, has been received and paid in February X8. Okay, so when was the final bill received? February X8. However, same was accounted in X8 X9. So the bill was received in February X8, but this bill got recorded in next financial year, X8 X9. So you are required to comment on its accounting treatment. So how should this be treated? Over to you. Quickly, how should this be treated? Tell me quickly, how will you deal with this? How will you record this? What is going to be the accounting treatment in the light of AS5? So let me just clarify this. So how will you deal with this? Over to you. Quickly, how do you record this? All right, great. So I can see some responses coming up. Jendra says, sir, in X8, X9, this will be recorded as prior period items. We are saying it's an error. Okay. Then Janvi is saying it's a prior period item. So this needs to be disclosed, and this also requires a separate presentation in the P&L. Okay, so let's discuss this. Okay, so then I think Priyanshi has answered this. Soumya is saying present it separately. Present it separately as what? Priyanshi is saying it's a prior period item. Devu is saying record this in the P&L of X8, X9. But when you record this in X8, X9, so what do you call it as? So how do you record it? Means what is going to be the nature? It's prior period, extraordinary, exceptional. What do you call it as? That is also important. Huh? Soumya says present it as prior period item. Okay. Anyone else? Any more thoughts on this? So what do you do? All right, so let's look at this. See, the final bill having been paid in February 8, this should have been accounted in X7, X8. Yes or no? Correct. When the bill is received in X7, X8, when should this get recorded? X7, X8. But it seems as a result of error or omission, it couldn't get recorded in that financial year. Therefore, when do you record this? X8, X9. Now you don't have a choice but to record in X8, X9. Therefore, it should be treated as prior period item. Okay. Alternative approach is to show such items in the statement of profit and loss after determination of current net profit or loss. Yeah. Alternative treatment means you present it in the P&L as a separate line item. Of course, that is something we have already talked about, that is what is you'll do for prior period items. Further, please also understand that it's an expense arising from ordinary course of business. Can we say it's not in the normal course? No, it's an ordinary course of business. Although abnormal in amount or infrequent in occurrence, such an expense does not qualify as extraordinary item. For better understanding, fact that the power bill is accounted for at provisional rates billed by the state electricity board and final adjustment therefore is made as and when the final bill is received. This may be forming part of accounting policy of the company. Okay, everyone clear? Clear on this? Yeah? Okay, so can you understand that two things we have discussed? One, of course, it's prior period. Second, why this is not exceptional, why it is not extraordinary. Fine, clear? Rohan says it's exceptional. No, what makes you say this is exceptional? Rohan, can you please explain? So when you say it's exceptional, okay, so for an exceptional, please understand the amount involved has to be quite significant. Huh? So in the given matter, so it's only 5 lakhs. Yeah, so 5 lakhs is not something which you will consider as exceptional. That's not a very significant amount. Okay. Soumya is saying that why it is accounted in X8 next line? Because it's given in the question. Okay, it's given in the question. Yeah, so it appears as if it got missed in X7, X8. So that's why it would have been recorded in X8, X9. Okay, so whether it was intentionally done or not intentionally done, it doesn't matter to us. We discussed. It's an error. Correct? And you call it as prior period item. Clear? So am I clear on this? It's a prior period item. Okay? Yeah? All right. So let's look at one more example. Company finds that the inventory sheets of 31st March X1 did not include 2 pages containing details of inventory worth rupees 14.5 lakhs. How will you deal with this matter in the accounts of Omega Limited for the year ended 31st March X2? Okay, so for the reporting year, this 34 ending 31st March X2, you need to comment. How will you deal with this? What should be the accounting treatment? Over to you quickly. What should be the accounting treatment in this case? Me quickly. What should be the accounting treatment here? All right, so I can see some responses now. Janvi says exceptional item because it's in the ordinary course of business. Rohan says prior period item. Soumya says disclose as prior period item. Then I think she's saying treat it as prior period item, present as separate line item, and disclosure is also required. Almaz has the same response. Soumya has the same response. Okay, great. Now see, clearly I think it's given in the question that it appears that while calculating the value of inventory, so there was a miss on the part of the accountant. Yeah, it's unintentional, but it's a miss. So if it's a miss, what do you call it as? Error. So when did this error take place? In the previous year. So will that be required to be rectified? Answer is yes. So this error will have to be rectified in the current year. So how do you rectify this? We'll call it as prior period item. Okay. We'll have to present it separately. We'll have to give a disclosure for the same. Okay. Clear on this? Yeah. Any questions so far? Everyone clear? Okay, great. Soumya, Janvi, they are clear. Okay, now another point. Let's take up that is about estimates. Now, as around the estimates, let's understand as to what is an estimate. See, estimate is something over which 100% accuracy is not possible. Yeah, so that's how we can define an estimate. If you look at useful life of any item of PPE, for example, if you say useful life of machine has been considered as 10 years. Okay, machine is there, its useful life has been taken as 10 years. So can an entity say with 100% accuracy that its life is going to be 10 years only? Tell me. Can you say with 100% accuracy that its life is going to be 10 years only? What do you think? Answer is no. Yeah, Tanisha, Devu, they are saying no. So there is some sort of approximation which is involved. Some assumptions will have to be considered, right? On the basis of which this life will be considered. Yeah. Now, as regards this life, we can say that this can be 11 years, this can be 12 years, this can be 9 years. Yeah, but with 100% accuracy, we can't say it has to be 10 years. That's what you have in case of an estimate. See, for an estimate, we can say 100% accuracy is not there. Not possible, in fact. So what do? You will take assumptions to get on to the approximation. Yes or no? Yeah. So there are few examples. Useful life of PPE. It's an estimate. Similarly, residual value of PPE. Again, that is what? That's an estimate. Correct. Similarly, actuarial valuation. Remember actuarial valuation we discussed for employee benefits. That is again what? That is nothing but an estimate. Okay. Now, because these estimates are not 100% correct, that's not possible. So that's why year on year, they may change. Yes or no? Year on year, they may change. Correct? There may be a change in that. So when you record some amount in the current year, next year it may change. But that change will not be very significant, of course. Yeah. And the change should not be intentional. So you should not be thinking that, of course, it's an estimate. So let's do some manipulation and let's make the wrong estimate in the current year. Next year we'll change it. Why? Because if you do that, then that's error. That's not change in estimate. Okay. Now, if let's suppose estimates are changed, say in a particular financial year, you had an estimate of 100. Let's suppose next year is changed to 110 or 90. So is that possible? Yes. See, the estimates are required to be reassessed at every reporting date. And whenever there is any change in estimate, then what do? Standard says you will record that prospectively. you will record that prospectively. Now, what is the meaning of recording of change in estimate on a prospective basis? Let's try to understand that with the help of an example. Okay. So now what I'll do is I'll pick up one example. Just a minute. Let me just share one file. Okay, so let's suppose there's a machine. Yeah, say its value is 10 lakhs. So when you purchase the machine, its value was 10 lakh. Its life was taken as 10 years. So can you tell me what will be the amount of depreciation on this? So on this machine, what is going to be the amount of depreciation? Tell me quickly. On this machine, what is going to be the amount of depreciation? Quickly. Great. Soumya, Devu, Almas, they have computed. It's going to be 1 lakh. Correct? Now, let's suppose depreciation has been charged on this machine over 4 years. 1 lakh, 1 lakh, 1 lakh, 1 lakh. So at the end of 4th year, can you tell me what is going to be the carrying amount of the machine? At the end of 4th year, what is going to be the carrying amount of the machine? Quickly. 6 lakhs. Yeah. Great. Okay. So its carrying amount will be what? 6 lakhs. Now, at the end of 4th year, what is the remaining useful life of the machine? Can you tell me? At the end of 4th year, what is the remaining useful life of the machine? Over to you. What is the remaining useful life? 6 years. Now, let's suppose in the 5th year, or let's suppose at the end of 4th year or beginning of 5th year, company has reassessed. Okay, so some reassessment is done by the company. And what did they do? They found that this machine will not be usable beyond next 3 years. Okay, so they reassessed the useful life, and what did they found? That this machine will only be usable for next 3 years. Okay, so now if we look at the carrying amount of the machine, what is that? 10 lakhs minus 1 lakh into 4. Now, after 4 years, what is the revised useful life, or what is the revised, or you can say what is the remaining useful life of this machine post reassessment? What is the remaining useful life? 3 years. Okay, so we are saying remaining useful life for the machine is what? Okay, so that's 6 lakhs. Oh, sorry, 3 years. No. In this case, when the revised life is there, so how will you now compute the depreciation? Depreciation will be computed over the remaining useful life. So therefore, now what is going to be the revised depreciation amount? 6 lakhs divided by 3. 6 lakhs divided by 3. So year on year, therefore, what is going to be the amount of depreciation? 2 lakhs. Okay. So this is what you call as accounting on a prospective basis. So whenever there will be any change in estimate, how do you record it? on a prospective basis, prospectively. Clear? Everyone clear on this? Any questions, any doubts if you have on this? Clear, everyone? So I think with this, we can just conclude our discussion over here, right? Now what we can do is any questions, any doubts that you may have, we can talk about it. And please remember that we are not through with this accounting standard also. So we are going to continue on this in the next session. Okay, now we can discuss your questions, your doubts. I understand Asta has a query. Yes, Asta, please go ahead. Asta, what's your query? Please go ahead. Is Asta, please pick up. Manish, can you please look into it? Please unmute Asta.
Yes, sir.
Yes. Yes, Asta.
Sir, in AS 15, we are not
Yes.
supposed to deduct the current service cost or interest, actuary cost, and past service cost if
So
they
what
are
is
recognized.
no? So what is the meaning of you are not supposed to deduct? I couldn't understand this point.
Sir,
What is the meaning
from
of
the
deduction here?
from the defined benefit obligations, past service cost that is not been recognized. What is
So what are you referring to? I'm not sure. Can you give me the reference of the document? I'll have to just go through that because as regards the defined benefit obligation, so it will have some components. What are those components? Current service cost. Okay, if at all there's any past service cost, plus the interest portion for the year, plus actuarial gain or loss. Okay, so these are going to be the components.
Sir, in the book it is written actuarial gains and losses to the extent that they are recognized.
Sorry?
Sir, what about unrecognized?
No, actuarial gain or losses to the extent. No, so again, Asta, I'm not clear as to what document you are referring here. It will be helpful if you can just help me understand the document you are referring. Let me just go through that part and come back to you. So can you give me the reference of the document? I'll just go through that because whenever you refer any document, okay, uh, till the time I do not have access to that, very, very difficult to answer that. Huh? So I would request if you can just give me the reference of the document or maybe the question number, whatever you are reading. Let me just go through that and come back to your query. Okay, but if you can just explain the complete query, then of course we can discuss that.
So the query is that current service cost or interest, past service
Yes.
cost, we all show in the profit and loss account.
No, so in the profit and loss account, you will not show that on a line by line basis. In the profit and loss account, what will happen? Let's suppose last year your defined benefit obligation was a net liability. Okay, say this was 100. Now, in the current year, say this was 31st March 24. Now it is 31st March 2025. Now what do you have? Now you have this liability net. Say this has increased. Let's say for example. So in the profit and loss, what do you show? You will show this 10. You will show this 10. So this amount of 10 will go to your P&L, but you do not give a split of this 10. Okay, into current service cost, into actually that split is not given. So this 10 will go to.
Sir, past service cost will also go to P&L when
Yeah,
we
of
have
course.
taken the policy.
Yeah, of course. So any past service cost, any current service cost, see everything has to go to P&L if that's a cost. So that's how you need to consider it.
Sir, means if we have taken the policy in 2025, so the past service cost in of that year and of the previous years will go to
No, so what
the
is the no. So again, what is the meaning of taken a policy? What do you mean
contrib-
by this?
contributions done by the employer
No,
in
so
2000.
contribution that you do is not a liability. Contribution that you do is an asset. That's why I'm saying this amount has to be recorded net of asset. Remember, we talked about it, that the liability that you will present will be net. So what is the meaning of net? You will have a DBO. Let's suppose in our example, when we are saying it's 100 net, let's suppose liability was 130 and you had this plan asset of 30. So that's where it's coming out as a net of 100. Okay, so if you have a plan asset, if you have a liability DBU, so that's what you present on a net basis. So if you are contributing something, that will go out as your asset, not as a liability. Clear?
Okay, sir. Sir, in the page number 6.14, it is being given that past service cost, it is a component of DBU, that it is to the extent that they are recognized.
Just a minute, you are referring to page number 6.14.
Yes, sir.
And are you referring to any illustration?
No, sir, they are just components of defined employee benefits.
No worries. So past service cost, I'll just go through. I'll come back to you on this. Okay. I've made a
Okay.
note of this point, huh?
Sir, in defined contribution plan, it has been written fixed contributions to be made. Fixed
Correct.
contributions, it is not a one-time payment, it is a regular payment.
Yes, of course. That's correct.
Okay, sir.
That's
Sir,
correct.
the employee relationship indicators have been given, that is a contract of employment exists. Individuals are for legal, tax, social security purposes,
Okay.
oversight. Sir, these all conditions to be satisfied.
In relation to what?
Sir, in relation to such as casual employees, they are not having the contract of employment in itself. So they are
No,
also having the employer-employee relationship.
no, so that's what we discussed. So whenever you look into AS15, so AS15 is all about employee benefits, correct?
Yes,
So
sir.
to begin with, first of all, you need to find out whether your benefit is in relation to the employee or not. So that's where the first thing that you need to get started with will be to check whether there is an employer-employee relationship or not. And I think we spent some time on this, huh? So just go
Sir,
back to our discussion on that and evaluate whether the arrangement that you are talking about is that of an employer-employee or not.
sir, in casual employees, only the contract is not existing. Otherwise, the oversight direction is all being given.
So
So there,
then we talked about this point also, whether it's a formal arrangement or informal arrangement, it will not matter much. Both of them may lead to employer-employee relationship. Okay.
okay, sir, means proper contract is not just required.
No, so that should be in place, but I'm saying if that is missing, but you have other reasons to establish employer-employee relationship, that can also be considered.
Okay, sir. Sir, you have said that the teachers of ICI like you are not been having a employer-employee relationship with ICI.
Right.
Sir, why? Because it is also a contractual relation and
No, so
some.
contractual relation could be for various things. Let's suppose if you talk about a company, okay, say for example, any company has engaged me. Why? They are saying that for our employees, you conduct a training program. Yeah. So does it mean that I become an employee of that company?
No, sir.
Why? Because they have hired a vendor. So it's like I am a vendor to them. Yes or no? So if I am a vendor, I am providing my services and getting paid for that. So that will not bring in employer-employee relationship. So the same goes with any other organization. Clear?
Okay, sir. Means a proper oversight is not there and you are conducting the other activities also.
Correct. So employer-employee relationship has to be in place for you to move into this employee benefit.
Yes, sir. Sir, you have explained at page number 6.4 that a careful judgment should be applied in assessing whether an obligation has arisen, particularly in instances where an enterprise practice is to provide improvements only during the collective bargaining process and not during any informal process. Sir, here what is informal process?
See,
Sir, why?
informal as we just discussed that it's not necessary to have a formal agreement in place. So at times, even if it's informal, but you are able to establish the employer-employee relationship, so you'll consider that. So that's the point.
Sir, but here it is written not during any informal process.
No, so again, I'll have to go through that part. So once again, I will request if you can just again mark this point, help me understand what is that point. I'll have to. Uh, so what are you referring to here?
Sir, second paragraph of illustration 2.
Which illustration? Illustration 2, you're
Second
saying?
illustration.
Illustration 2. Okay, I'll go through this. In fact, I'll just try to keep
Okay.
it handy next time so that we can discuss.
Okay, sir. Sir,
Okay.
sabbatical leave means
Sorry?
sabbatical leave. Long
Sabbatical,
term.
you can say it's a kind of leave arrangement which the companies may provide. Okay, so the employee can request for this type of, so it's a category of leaves, generally for a long period of time. Okay, so the employee can request the employer will approve these leaves, and that is what will fall into this category. So it's for a long period of time.
Long. Okay, sir. Sir,
Yes.
it is the second point. It is written jubilee or other long-term benefits. Sir,
Okay.
jubilee means.
Jubilee, I'll have to find out what is the meaning of jubilee they are referring to there.
Okay, sir. Thank you, sir.
Sure. All right. Let me just see what more queries we have. Okay, so now Devu has a query. Devu is saying insurance claim received. Should they? Yes. So I think again, considering the amount involved, Devu, you can consider that to be yes. Because that's not something which is in the normal course of business you'll have. Yeah, so that's why. But again, everywhere you need to have this amount in place. Huh? So this amount has to be one of the considerations. All right. Any more questions if you have? No, so then we can just close this discussion. Yeah. Okay, so thanks everyone for your time and for this wonderful participation once again. Just make sure that you revise what we covered today because we are going to continue on this accounting standard. Huh? Okay, so thanks everyone. Yes, over. Thanks, Manish.